Welcome to Subramani. While talking of building a dividend yield portfolio, there are certain things which are important. I mean, it's not as though only for a dividend yield portfolio this is important. This is generally important for any equity investing. So some of my learnings, I'm not even saying this is complete or this is comprehensive, or I have not forgotten an important one, because even though I don't have a script on this, I have something scribbled down but not really a script. So what is the first one to learn? The first one to learn is you need to have a diversified portfolio. You need some commodity stocks, you need IT stocks, you need banking stocks, you need maybe a mutual fund stock. Mutual fund companies also have a high payout. So look at building a portfolio which is reasonably diversified, because some things can go wrong, right? You can't put all your money in IT saying, wow, IT, I'm getting fantastic dividend yield, because if suddenly the income vanishes, then the dividends vanish. And very many big companies, GE, IBM, Coke, P&G, have all cut dividends in the past, right? So I'm giving you all US examples because they have a fixed formula saying this is how we will do a payout. In Indian conditions, the best payouts are made by PSU shares, because the government forces them to pay out dividends. So whether it is an NTPC, Coal India, Indian Oil, they are not allowed to keep too much cash in their books, because the big shareholder, that is the government of India, wants the money, which is fantastic because it suits you also, because you also know that PSU companies, when they have a good earning, they will have to make a payout. Even if they don't have a great earning, they will have to make a payout. Some of them go to the extent of borrowing to make the payout. So that is a little scary, because you don't want that to happen. You don't want it to pay you dividends out of capital or out of reserves. That you don't want to happen. But be careful about creating a diversified portfolio, PSU, IT, banking, commodities, some companies within FMCG, whatever if you see, because FMCG also I see a huge valuation disparity between companies at the top and companies at the bottom. So if you can pick up something at the bottom and find a good dividend yield, maybe FMCG is not a bad place to invest even for dividend yield. So creating a diversified portfolio of say 10 to 15 companies, maybe 20 companies maximum, you don't need more than that, definitely. So if you, what is the advantage? Well, if you had invested in the American markets, and let's say before 2007, you saw companies like AIG, Bank of America, Merrill Lynch, all going down under, right? They went and sought government funds, so dividend payouts stopped. Be careful about such things. So you need a well diversified portfolio. Simple. As investors, especially people like us who are earning on a monthly basis to invest, you will build your position over a period of time, and that is not too bad. Like from 119 to 187, if you had kept on buying Coal India, that you would still have done well, because when the price is 119, you may not have had enough money. Maybe you had only 20,000 rupees, so you went and bought 100 shares. That was 11,900, right? That's all you had. You didn't have. So doing an SIP, of course, it gives you worse returns than what you do as a lump sum, but you did not have money to do. If I had 1 crore of rupees when the price was 119, I would have put 1 crore of rupees in at that price. But if I didn't have that money, and if I had money only 12, 13,000, 15,000 per month that I could invest, I would have to invest in increasing prices. I do not have a choice. So building position over a period of time is bound to happen for people with limited income. It's for fund managers who suddenly can get a big spot. This will not happen to ordinary people who are investing out of their earned income. If you're investing from an inheritance, or if you're investing from some other, if you've sold something and you want to invest, that's a different case. But for most of us, an SIP method of acquiring shares is what will happen. I'm not recommending it to everybody. I may not always do it that way. I may wait for the price to correct. At a higher price, I may sell. I'll do all kind of things. But be careful, because all portfolios anyway get built over a period of time. It takes 20, 25, 30 years to build a good portfolio. And we keep putting money regularly, then the dividend comes, which we may not need, we reinvest it. That is how we all build our portfolios. Another important thing is don't chase dividend yield stocks. Some stocks look very good on paper and say, wow, this is fantastic, we should be buying. but after some time it may not be paying good dividends. So be careful about seeing which is the company, and don't chase dividend yields. Yes, on paper it looks good, but sometimes in some websites the bonus is not adjusted, so the old payout ratio is shown or old EPS is shown. So when you think, wow, the dividend yield is fantastic, not always, right? Be careful about the numbers, be careful while you're doing research. Don't use too much of leverage. Just imagine if you're getting money at 8%, and you're getting dividend yield of 12%, it looks very attractive, right? So don't do that. Don't do excess leverage. Don't do leverage at all, because you're building a portfolio for your old age. So why should you leverage now and then repay the loan? Invest only what you leveraging to build a dividend yield portfolio, to me is not very appealing, but there will be very many instances where the dividend yield was greater than the bank interest, so therefore it made sense. To me, no, it makes no sense to borrow, whether to borrow excessive or whether to borrow. To me, it makes no sense to borrow to invest. So that's my view. There is somebody else who could say, no, in the month of April I borrowed 5 lakhs and invest the money, and over the period of year, instead of doing SIP or anything, I am busy repaying the loan. Is it a good way to look at it? I am not very keen to borrow money to invest in a dividend yield portfolio, right? It's too risky. So don't use excessive leverage. Don't be in companies with very excessive leverage. Leverage can hurt all this. Another very important thing is, suddenly you might find a share which you thought was a good buy at 110, hovering at 130, then 6 months later you see the price is 135. Then you say, oh, now I think it's a new low, the company will never hit 110 again, so this is what my broker told me, etc., etc. Therefore you justify the price at 130. But please remember, you need to look at two things: dividends and increasing dividends. If this is not happening, don't overpay. Generally we think, oh, my father got this share and therefore I'm getting a good dividend yield. Yes, but then that is 20, 30, 40 years of holding. You need to know that. So your own portfolio can't perform as well as an old portfolio. Or rather, your new shares cannot perform as well as the old members of your portfolio. So be careful about that. Understand what you're investing into, right? You can't just look at one ratio called dividend yield and say, oh, there's good dividend yield, so I will invest. Maybe there would be ESG issues. Maybe there would be people would say, oh, it's a coal business, coal is going to be replaced, whatever. People will have all those kind of views. So understand what business you are getting into, asking the right questions, asking the right people the right questions. All this is very important. Try to understand the business, because if you don't understand the business, you do not know. And if you do not know why the dividend payout ratio is high, one day when the dividend payout vanishes or the dividend vanishes, then you will say, oh, this is what he said. This is, don't get into that kind of a thing. So if you don't understand, do not invest. Thank you.